So thank you. So in this short session, I will again explain. I have talked about this previously several times. So if you have attended, then it may be a repetition. But if you have not, then it's new. And I'll hold some new topics going forward. Uh, Probably I'm getting ready for this Sunday, 5 p.m. So I'll teach something on Sunday, 5 p.m. This is about how we work during the day and how we communicate to the members. And uh, you can get some idea also what we do during the trading hour. So I'll explain. So in this session, I'll explain to you from the beginning when we send the alert, what kind of message we send, and then when we send you the targets, then what you are expected to do with the targets, and we are monitoring the targets and alerting you. We have a multiple exit system, so uh, we scale out, and sometimes we scale in, and the multiple exits are complicated. On my side, I'm constantly building the various criteria for exit. So it is said that the trade entry can be very simple, but the exit needs to be complicated and complex. So you should have multiple exit criteria, not just one that the target hit and out. That's very simple. If it's working, okay, fine. But the the thing don't work like that. It's not that simple that we buy and then we wait for exit and then hit and then we are out. So things don't work. There are a lot of things to be watched during the day. So so you see the slide called how our trading system works. So when the market, before the market opens, there are two kinds of monitoring. So it's called detail monitoring. So the monitoring is divided into two parts. One is called overview monitoring, and then another task is called detail monitoring. So in the overview monitoring, what we do, and in a detail monitoring, what we do, and then I'll explain um, the syntax of our trade messages. So in the overview monitoring, when the market, first before the market opens, we need to do the detail monitoring. So what is detail monitoring? Detail monitoring is that you are on a high alert and you are watching everything um, very closely in the pre-market hours. So what very closely? Well, all your open positions, see the situation in pre-market, any news, anything gapping up, gapping down, what you have. Um, what is the condition of the market? All four major indices: Dow Jones, Russell, Nasdaq, S&P, cash market, futures market, ETFs related, other ETF related commodities, financial ETF, semiconductor ETF, indices ETF. So all that you go through, you need to have a system to go through and monitor those. So where the situation, what is the situation? So all that is going on in the detailed monitoring before the market opens. So when the market, then when the market opens, it's like horses running now. So everything is running. Oh my God, it is running, this running, this running. So, but if you have done the preparation before, if you have a routine, so your brain is trained. So you can train the brain. But if you don't train your brain, then you're hectic. So if you have a process of following the same thing again and again and again every day, 5 times a week, then you don't have to panic because it becomes a second nature. So your brain can decide and tells you. Plus, if you have a system which tells you clearly some mathematical, some alert system, some messages, some way that you know where you stand. What are the targets of the positions we are moving, which are about to hit, may hit, whether based on our system, whether it's a green, yellow, and red, and then you know what you're supposed to do for green, yellow, and red. So you're calm. So now when the market opens, we still moving into detail monitoring. So when the market open, we go more deep into detail, and we start to watch everything what we have. in our portfolio along with the market. So what we have and along with the market. So uh, so as the time passes by, when the market opens, there will be some position you need to take profit, especially those which gap down. So when the stock gaps down, uh, those are the one, and you are in the position and you have puts. Let's say you need to monitor those uh, quickly, because those after gapping down, they may gap down and then that's it. They just don't want to go down any further. So you have to quickly review those symbols which are gapping down. Like some of them today gap down. Puts the other day bought the puts and then they gap down. So when they gap down, chances are that they will make a low during the first 30 minutes and that's it. They just dwindle. And especially then so you go how you monitor detailed monitoring. You need to monitor on a 3-minute chart. So that's my lowest time frame for monitoring these open positions which need to be monitored. So immediately switch. You have a system. So I have 14 monitors, 2 desktop, 1 laptop, iPad as a backup, 1 cell phone, 1 desk phone. So all that. So one monitor is just for 3-minute chart. So 3-minute chart, I put the symbol, I see the 3-minute. So when the stock gaps down, look at the quickly evaluate the support level. Is it gapping down to the support level? Chances are it is. Is it the 200 level, 50-day moving average level? Is it some previous turning point? So evaluate that. Look at your option. Sometimes you bought yesterday, it gapped down in a 60% gain. So you rather take 60% gain now than maybe 80% next week, especially if it's Friday. So if it's Friday, then you're losing 2 days of rent. So it's every day an option. We are renting. So Saturday, Sunday, your rent was wasted. So all this is going on. How many positions you have? What is the condition of the market? Maybe you have a new position coming in. At the same time, you're running the scan, going through your list and seeing which one is looking good. So all this goes on in a detailed monitoring, and then the 30-minute pass, and then you step back, not setback, step back and start moving your symbols from detailed monitoring into overview monitoring. So all this goes on. So for us, I'm doing it, and at the same time, I'm finding the new candidate and sending you the trades. So let's say I found a trade called Meta and decided that Meta is going up and we can buy March 245 calls. Just for example, March 245 calls we can buy at $10. So I don't send you the story behind the trade. Nobody cares about the story. You can read the story, all the fundamentals and all that online. They are available. The members, but if I am subscribing something or based on my experience, members just want to get the short and sweet message on their text or email that buy this. So buy Meta 245 calls at 10. That's it. And it should be trading at 10. So it's not like trading at 10:50 and you're sending alert at 10. So what's up? So it's not like that. I monitor and I send you the real trade. So sometimes I do 10 cents less than, if it's a bigger spread, then I see it that the stock is pulling back, and by the time alert goes and the pullback price will hit, the option will not be trading at 10. Maybe it should be trading at 980, and the bid is 950. So if bid is 950, ask is 10, and the stock is pulling back a little bit on a 3-minute chart, and I can see if it can go another 20 cents up and 30 cents up, and then in this process the bid will be the ask will be 980. So I can send 980. So let's say I send 10. This is the ask price. So so the syntax is Meta, which is symbol, March, which is a month, 245 is the strike. We always buy third Friday expiry. And then this is calls, if it's calls. If it's puts, it's puts. And then buying to open at 10. So buying to open at 10. And that's it. So we send this alert to our mailing list. and we execute the trade in our account. And then, so before this trade is sent, there's a lot of homework has been done before. It's typing this message is just taking action, so bold action. So this took the action that buy this, but before that, a lot of work has been gone through. So I'm a uh, so rule-based discretionary trader. So you should know who you are. So I am rule-based discretionary trader, meaning I follow certain rules. I am a visual-based trader. So I don't follow indicators as such. So I'm a visual trader. So I spot the trade on my daily chart. So when I see on a daily chart a certain pattern, then so that's where I start my daily chart. So I lean back on a weekly chart to see if what does weekly chart say. Then I switch to 2 hour chart or 4 hour chart. Then, so daily chart is telling me, okay, this has further room to go. It is just the beginning of a trend. So I go into that trade. So this is just the action I'm taking. But before that, the lot of work needs to be done, and you need to be prepared every day to uh, take those actions. So it's called low risk trade idea, meaning low risk trade idea means that you keep on taking the trading system aside, that you keep on taking the trades, and over the long run you will be profitable even though you suffer a short-term setback. So even if you suffer a short-term setback, over the long run you will be the winner. So of this sentence, which is a 3.5 line, is deep. So is so a lot of work goes behind. So a lot of work went behind, and then find the meta and then send the alert. So now what? So before we send the alert, we know the targets of both sides, exit and stop. We know all the support and resistance, and we know the buying and selling, and we evaluate the options also, whether the spread is okay, volume is okay, and then also do the activity. Look at the activity, which strike is having the activity. So sometimes, or most of the time, if you look closely, pay attention when you're trading options. Pay attention to the option strike where the most activity is. So that tells you something that the traders are doing something. They are, follow the crowd. Crowd is majority of the time. Crowd is not wrong. Crowd is correct. So if the if let's say mm, Meta is trading at, so we are buying 245, and if Meta is trading at 247 and 288, and so I have a choice to buy 250 calls, or I have a choice to buy 245 or 240. So look at the decision to buy this strike. A lot of work goes on um, behind selecting the right strike. So I will show you the slide next time. A lot of variables to decide which strike to buy. So let's say we decided to buy 245 strike, and we know the target. So after I send this alert, then take a break, like 10-15 minutes. We have to do some other work behind the scene, and then we send you the message regarding the targets. So uh, besides the message regarding the target, if we find the news, we send you the news. If we have any technical things to say, like we prepare the chart, send you the chart, short one or two bullet points about the chart, what we are seeing, any volume. So you need to have a proper system of evaluating the volume called relative strength volume. So I evaluate the volume, the relative volume for that time period. So you can work on it. I've developed the formula, so I know the relative volume. And then so we update from time to time. And then this is the most important. Get ready to take profit of it. So we send you the alerts. So I'll show you what kind of alerts we send, those various sell alerts. So next few slides, I'll tell you. So these kind of different messages we send you the message in the pre-market, any position open, and we know that you need to be aware of the targets. If we need to revise a target, we revise the target to the upside or downside to maximize the gain. So we know that market is gapping, this is gapping down and is already hitting the second target. So we need to revise. So we send you the revised target pre-market and send you the alert right away, like today we did. So determining the target, this is the most important. Where are you going to exit? Anybody can just buy calls and puts, but where to exit? So it's like, okay, you told me to buy this, now I bought it. Now where do I exit? So so determining the target. So this is where the technical analysis comes. So determining the target is an art and science. So when you are trying to first, when we are trying to figure it out, the target is need to be laser focused on it. And then not only that, when the stock is traveling towards the target, then you need to be laser focused on is this movement. So it's like a precision guided missile is just moving towards the target. So do you have a system of monitoring the target when it's hitting the target or before it even approaches the target, to set some system where you are notified before even the target is hitting? And what target is hitting? Is it the first target? Is it the second target? Is it the third target? Do you have any, are you going to upgrade any target or downgrade any target? Where is the resistance? Where is the support? Maybe you're setting the target for calls beyond the resistance level. So if you set the target beyond the resistance level, so the resistance will hit and then the stock will not move and your target will not hit. So what's the point? So evaluate the resistance constantly for the stock which is moving up. Make sure that the resistance is not hindering your target. If you set the target beyond the resistance level, then that's not good. If you think my profit objective is 50%, your profit objective has nothing to do with the stock, because the stock will stop where it's supposed to stop, which is the resistance level. So it may hit 45% profit and there is a resistance, and then there is a 50%. So that 50% profit did not count. So people, I don't know how people put their target based on their own desired profit objective rather than taking help from that market. So take help from the market. If there is no profit potential of 50%, then if that is your criteria, then just ignore that trade, because there is no 50% profit in option. So you just say, okay, I ignore this trade. There's no much potential left. There's not much potential in it. My minimum is 50, and if not there, don't take it. So just, yeah. So in other words, take help from the stock itself and see if there is a potential. If not, then just move on. So we provide three kinds of targets. So multiple targets, and in each we call it green, yellow, and red. And then there is something called beyond red. So for each target, not only the target, so when the target is hitting, then we have to see, if we are trading option, when the target is hitting, then we have to see how much is the gain. If the target is hitting and the gain is also reasonable, option gain, when we exit. If we have the ability to hold on to the next target, because the gain in the green target is not enough, then we hold on for the next target, yellow target, and the red target. So I will explain what is green, yellow, and red target. So the green is first, yellow is second, and red is third target. And then we call something called beyond red target. So I'll explain these targets to you, what we mean. So the green target. So if you're traveling, so if you're traveling, let's say if you're traveling from San Diego to Seattle and you put it on a GPS and it says 24 hours, you leave right now San Diego, you will arrive Seattle in 24 hours, but you know you're not going to arrive in 24 hours. This is just assuming you are just traveling non-stop and you are perfect. So you just keep going, no exit, no stop, nothing, and then you will arrive in 24 hours. but then you arrive in 72 hours because you took many exits, you slept, you took lunch break, dinner, etc. So the further is the target, the lower is the probability of its hitting, and the time factor. So the target is far, it may take some, so it may take time. You don't know how much time. Plus, you don't know if it will even hit. So the probability is down for the target, which is the distance plus the duration. So we don't know. But if the target is closer, like only 10 miles, so if you put it on GPS 10 mile, it will give you 8 minutes. You may arrive in 9 minutes. If you speed up, maybe 7.5 minutes, so you save 30 seconds. Most likely you will arrive at 8 minutes. I mean, they are accurate. So the closer is the target, the probability is very high. So, but you cannot put the target so close because we are trading options. So when we are trading options, we need to have some decent target from the current entry price, the green target. If we are entering at 100 and I say green target is 101, then you say, Noshi, what's up with this 100, 101? We are not trading stock. By the time 101 hits, I will be, and it needs to hit quick, I will make like 20 cents in the option. So it has to be some decent distance from the current price so that the option, when the green target hit, at least have 25 to 30% gain. So provided the green target is hitting in 2 to 3 days. So if it's not, then green target will hit and the gain will be 15% or 10%, or sometimes even in red. So it depends how long it took for the target to hit green. So if there is a momentum, the green target is just hit right away. Next day, it just goes to green and yellow. So I monitor it. My team monitors all that, what the green target is and what kind of out gains we have. If we have only 15% gain and the green target is hitting, then we revise the green target, say, no, don't sell, um, hold, this is the new target. So the characteristic of green target is this is immediate target. So likelihood of hitting it is high. So 90, so it's like 95% probability of stock hitting this target because it's not that far. So it's 3%. So you can say 3 to 4% from the stock point of view. So any move in the stock, 3 to 4 or 3 to 5% move in the stock, and if it moves in within 2 3 days, that gives you 30 to 40 50% gain. So that is the logic. So 95% probability stock hitting this target. So we send you the alert to sell at least 1/4 or 1/3. So 1/3, so 1/3. So we send you the alert, you can sell 1/3. So if you have 8 contracts, you can sell 2 if it's 1/4 or 3. But ideally, you should be holding not for, don't try to sell whenever we see a little green, because that's the way we are trained. Our brain is trained to lock our gain fast and let the loser grow. So in other words, so chances are that if the green target is hit, you have to decide how many contracts you have. If you are overexposed, then maybe you sell it. But if you have the proper exposure in that position, then go for yellow target because that's the optimum target. But if you're overexposed, you average down and you have instead of $2,000 in the trade, now you have $3,000 in the trade, and so green target hit, you say, okay, I'll reduce my exposure by selling 2 contracts. So the nature of the green target is such that there is no resistance. So there shouldn't be any resistance. So if it's a resistance there, then it's a minor resistance. It's not major, or it's not that complex that the stock it hits green and then it falls apart. So it's not like that. But stock is a stock. You don't have any control. If the stock goes for some reason to green target and then it will start to dwindle, and then next day, 2 day, 3 day pass. So green target hit, 3 day pass, it may have turned, that green target has become a resistance. So now we are looking for exit because we see that, okay, it's not passing beyond green target. So you have to constantly evaluate your target and see if the target has not created any resistance, because the target, what the target we are seeing, others are seeing too. So if we are selling, others are selling too. We are selling options, others are selling stocks, or maybe they are doing something in the option which is causing the reaction in the stock. You know, they do all kinds of things. So it itself creates resistance in the stock. So if it starts doing it, so there is a time-based criteria you can insert, that if the green target hits and then I'm holding it, I sold two, but the green target has hit 3 days ago and it's not moving beyond green, is not going to yellow, so I may sell. But this happens less frequent. It happens in yellow. So so stocks are expected to continue towards yellow target, which means the second target. So sell some alert is sent, which is sell 1/4, sell 1/4 or 1/3 of your position. So when we send this 1/3 or 1/4 position, we document it. So we know we sent you this alert. So we know we sent you this alert. We know what date we sent, what time stamp, and what was the option price when we send you the alert. So we document that option price, the date and time, and what kind of alert we sent. So we have that system, we maintain it. Now the stock is moving towards yellow target. So when the stock is moving towards yellow target, which is called second, also called second target. So I call it yellow, just like traffic light. So when we see the yellow light on traffic, we are supposed to slow down and get ready to stop, right? So it's the same concept. So yellow target is based on the resistance level, not the resistance, but the below the resistance. So if you put the target at resistance, then you have to put some offset. You have to put some leeway between the resistance and the target. If you don't do that, then you get caught. You're holding it, and then you wonder. You say, "Okay, I set the target of 100, and it went to 99.50, and it never went to beyond 99.50." So you were greedy. So jump, back home when I travel on the train. So if it's a small station, I can see my house there. I didn't wait for the platform to arrive. I just jumped from the train because I don't have to go to the platform. I just see my house right there. So same when you know that the resistance is 100. If you set your alert, I have a member. I send him the target, let's say 100, he set the alert as 149.90 or 99, something like that. And what happened? Bid. So the bid can hit, but so the ask didn't hit. Something happened. So don't be that greedy. When you are about to exit, you need to exit. So just don't haggle over. You're haggling, but your exit protocol has triggered. You know where the resistance is. So don't haggle for little price. Just exit. So get it over with. So the second target is a green, beyond the green target. It has a lower probability green because now the distance. So there are many factors. The distance is far from the current price. It takes time. There are a lot of, even you going through from one city to another city, there are a lot of hoopla hoops. So you have to cross. It just doesn't go straight. So time will pass. Some event can occur. Some resistance can get created. Some news can come. So there are a lot of things goes on between the current price and the yellow target, and between green and yellow. So between green and yellow, there are a lot of things can happen. So the probability is lower, 85, but 85 is still pretty good. And we evaluate the resistance level for the calls, and we evaluate the support level for the puts. So the support should be beyond the yellow if we are holding puts, and the resistance should be beyond yellow if we are holding calls. So the way it is the stock. So the stock can hit the yellow and then pulls back because that's the resistance. That's the way the resistance works. Maybe it will cross later after 2-3 days, but chances are it will pull back unless some major news comes and there's a lot of buying going on and it just keeps going. So a stock expected to pull back after hitting yellow. So sell majority. We send you the alert to sell majority. At least sell half. So again, now it depends. You have to be flexible. If you're rigid, you're not going to make money in stock market. You have to be flexible. So flexible means, okay, the stock is hitting yellow. How long it took to hit yellow? 2 days? Maybe I sell half. It took 10 days. Now it's finally hitting yellow. Okay, I'm going to sell everything. 5 days, maybe I sell half. What is the condition of the market? All that variables play in, all these factors play in your decision. You need to decide. So you can manually take the decision. So when you're making so if you're making a manual decision, I'm sure you will make mistakes. Sometimes it will be this decision, sometimes it will be that decision. So anywhere, anytime when we are making this kind of decision, try to create a decision matrix. Maybe you can create some matrix saying, okay, if this criteria follows, I'll take this decision. So that's the way Trade Genie, we say, okay, these are the variables, now this is the decision. So sell maybe one majority, maybe sell half, maybe sell everything, whatever you have in that position, just sell. Maybe just hit the yellow target the same day. If it's hitting the yellow target same day, you just entered and you got lucky, and by the time market close, it's hitting already, it's sitting there at yellow, and it happens. So if it's hitting, then you say, okay, I'll sell just 1/3, because, and what if it hit the yellow and it crossed the yellow target and it's sitting beyond the yellow target, and then you know that resistance, so resistance is conquered. So if the resistance is conquered and is the stock is sitting on the other side, it's like a river. Let's say a wild river, and a dog is chasing you, and you jump in the river, you know how to swim, and then you stand on the other side of the river, and then you laugh at the dog, ah, ha, ha, come and get me. So it's the same way. Stock, it crossed the river, yellow target, now it's on the other side. So you say, okay, I enter today and it is yellow by the near the market close, so why I should sell? I just hold it. Maybe you hold all the, hold, there is something going on, you did something right with that trade, because you bought it and it's hitting. So maybe you give few days, maybe just sell 1/3, make yourself happy, or just hold it. So if 8 contracts a bar, maybe sell 6 or 4, depending half or majority. So we do send out the alert whether to sell half or majority, and and then so after we send out the alert, if it's an early morning alert, then we monitor for the rest of the day and see what else is going on. So if it stops and we see the support is resistance is building up, or it's Friday and we have other position open, or we are about to open a new position which will be a fresh, this is stock is trading for last 3 days or 5 days of down move, so 3 to 5 days down move, I rather so if, and because it's option, if it's a stock, maybe I hold it, but it's an option, it's Friday, 3 to 5 days of down move, and so it's time to close it. There's another position ready, which is fresh from the oven. So it's like, okay, I rather put my dollar into this new position and close this one. So if the stock hesitates to move up, sell rest. So we do that. Then a red target. So the red target is the target which is have at the major resistance. So third target and after yellow target. So it's a third target and after yellow. So 70% probability of hitting that target. Just a second. So 70% of probability that it will hit this target. And the red target is designed that it's set at a major resistance, below major resistance if it's a call. And if it's a put, then it's just above the support level. So be careful when the red target is hitting. So we do provide red target and it says third target. So when it's hitting, you are expected to close the trade unless we send you the alert to hold. And the reason we do that, when the red target is hitting, we send you the alert to hold if the red target has been crossed successfully with some leeway. For instance, if the ATR is, let's say, $3, so we take, let's say, 40% of the ATR or 30% of the ATR, and we say, okay, the stock has crossed the red target with the bang, and this is the ATR and this is the volume, so we need to hold. Or if we are holding the call and the stock goes above the gap up, so if it gaps up, we hold that trade, unless after gapping up it just a second, I'm getting bothered by this. Alerts are coming. Just all the sessions are being recorded, so just a second. I am doing something. Just a second. Trying to close. Okay. Share my screen again. So the red target is set just below the major resistance. So the yellow target may have some resistance, but it is supposed to have a minor resistance. But the red target is set at a major resistance. So when the red target is set at major resistance, below the major resistance for the calls and above the major support for puts, then we need to be careful. So a lot of time the red target is conquered. When the red target is conquered, then what kind of action is happening at the red target? Is it a big volume going through? Is it? It's not a climax. The volume is there. Did it gap up above the red target? If the stock gaps above the red target, for some reason it gapped above, then it's I try to hold it, because I consider it that the resistance is conquered and it's just like a fresh trade. So I take my chances and I hold, uh, and then watch during the day. If it crosses the red target during the day and then it comes back down below the red target and closes below, then that's a sign that the resistance conquer was not successful. So the resistance was met and the traders are selling. So we monitor the red target for you. We do revise the red target to the upside. So the way we revise the red target, which is the third target, we move one step behind. So we move the red to yellow, yellow to green, and then we put a new red target. So we send you the red target, and then in the trade alert it shows by arrow. So we put the arrow, green arrow meaning above, red arrow meaning down. So we do show, so you can see what we are doing. Any middle target can be adjusted upward, downward. So when we are evaluating the trade, we are also we are evaluating and we are saying, no, this target is not right. Put it here, put this here. So we manage the target and resend you the email with the revised target. So if the target is revised, is to capture more gains. So we do capture more gains, and that's the reason. If it's puts, then we revise it downside. If it's call, we revise it to the upside so that you can have more gains. So what are the reason? I told you already. The stock gaps above red target or gaps down below the red target for puts. So if this is a phenomena happening, we are happy and we monitor it. And the stock needs to stay above. For calls, the stock needs to stay above red, and for puts, the stock needs to stay below the red. And we also evaluate, is it a safe to hold? So you don't want to get caught in the stock which you think the resistance has been conquered and later the stock reverses, because the resistance is not just one price point, it's a distance. So it's a channel. So everything is taken care of. So look on the left side also. So we look on the left side and then decide. Breaks below red. If it goes above and below red, then we close it. We sell immediately. So we send you the alert to sell immediately or sell the rest, sell all. So all kinds of targets, messages we send you. Sell all, meaning, okay, sell everything. And why we saying sell all? Because we have not sent you any sell alert before. So sell all. If we have sent you the sell alert before, then we send you sell rest, sell the rest. So meaning you have sold some, now you sell the rest. Sell immediately. Sometimes we have an urgent message, or sometimes we send you the alert to sell by market close because we don't know we are having a gain and it's crossed the red target, so we just say okay, just sell by the market close. So if market close for you is 10 a.m. Pacific on Friday, then you sell it at 10 a.m. If it's 12:55 p.m. Pacific, 5 minutes before the market, you're sitting in front of computer, maybe you sell at 12:55. And it also depends how much skill you have. You are a seasoned trader, so you can make your own decisions. So a lot of my members, they are seasoned. They just take their own decisions. A lot of members, they have just cell phone. They just say, just tell me when to buy and when to sell, and I don't care anything else. Can you do that for me? I have a cell phone and I am a surgeon. I cannot act while I'm performing surgery, but other than that, I can act. So can you provide that kind of service? I'm a surgeon. So I said, okay, we will send you, but up to you. Just don't leave the needle inside the tummy. So literally, I have members who are surgeons. So breaks below red, sell immediately. So targets, upgrades, downgrades. Targets adjusted upward for calls. So we're constantly looking for the any opportunity to raise the targets. First target price is replaced by second target price. So when we are upgrading, we are upgrading. Second target price is replaced by third target price. Okay, and a new third target price is given, which is a new red target. And target may get adjusted to downside too. So when the stock gets hit, so you cannot be rigid that leave your profit objective intact. That okay, I only get out at 50%, and you see the stock is just not moving. So get out. So we downward adjust the targets also. So these are the different kinds of messages: selling one third, selling half, selling majority. So all these messages, selling res, selling all, is depending on what we did before, depending on what the stock is doing, depending on what the market is doing, depending on what kind of position we have, how many open positions we have, depending on if we are trying to open another position. So a lot of things goes on. So exits can be complicated. It can be price based, it can be percentage based, it can be profit objective based, it can be time based, it can be market driven based, it can be event based. So many criteria taken into consideration to, and then you have your own individual. I'm different than you, you're different than me. So different criteria. And maybe we sell everything, the market is just going through hell, or the market hit the major target. So close when major target hits. So it doesn't matter how much you like to hold the position, but when the major index hits, so now you don't know which major index. There are 4 or 5. One of the index hit something and you're not aware of, and because of that, it is having effect on the overall. Sometimes the effect is immediate, sometimes the effect is slow, slow, slow. So little bit here, little bit there, little bit there. So if you're disciplined, you say, okay, this is a major target hit, and I am going to close my portfolio. Sometimes you have to close the portfolio as a basket. Just close it, close all. So just close out. You know, the net result will be negative after a few days. Now there is another thing called conditional order. You can set the conditional order. So people ask why you provide the stock target, why you don't provide the option target. So I don't know what the option will be because I'm trading a stock. I'm just using option, but looking at the stock target. So if the stock is trading at 35, my target is 31. So I see $4 target. Now, do I really know that $4 will hit tomorrow? And based on all the Greeks in the option, this will be the option price. Maybe people have the system; they can predict. I mean, I can calculate the option price if I know, but how fast? But I don't know. So if you don't know, you're just estimating it. And if you put that sell order, you bought at 4 and you estimated $4.90. This is my calculation. And the option goes to 480, and that's it. Maybe 490 was ask price. You calculated so accurately, but you forgot. You calculated ask price. So 490 is ask price, and your order is set 490, and it just goes to 480, and your order doesn't get filled. So how about whatever is the price? provided there is enough liquidity and the spread is narrow, whatever the stock is hitting the target, then sell my option if you cannot monitor the market. So you can set the conditional order, which is a conditional order means condition. So condition can be anything. So one of the condition could be that when the stock hits 31, sell my option contract at this market price. So you cannot set the limit. Your order become a market order and it will be executed at the last price. So make sure you're not setting this conditional order in some stock which doesn't move and there's not much liquidity, because the last price will be some weird last price which was traded like 2 days ago or 2 hours ago, and you will get the bad fill. So when you're setting the conditional order, make sure you're setting it in for the liquid market and the spread is tight. Otherwise, you have to estimate and sell or wait for the stock target to hit. When the stock target hit, you get the alert and you sell the option at that time. So another important thing which traders don't monitor is the pre-market action or after-market action. So sometimes the major target, especially if it's a red target, if it's a red target and the stock has an event coming up or came in a pre-market or for any news and is trading aggressively in the pre-market and the red target is hit. So if or any resistance level, so just forget about red, any resistance level has hit during pre-market hours and you're not aware of it, so all you know that, okay, you don't even know that the stock was trading in pre-market and then the market opens. So market open, let's say your order was set at 100 and it has already hit 100 in pre-market, and when the market open it's trading at 99. So 99, 99, 20, and then you're waiting for 100 to hit. 100 is not going to hit because 100 has been hit in the pre-market, or 100 will hit right for a few seconds and then it will drop like a waterfall decline can happen because somebody regretted not selling in the pre-market or was unable to sell. Maybe he had a big order to sell and he waited for the regular session, and then when he's selling a regular session, and then you did not even get the chance to sell your position, the option position. And maybe because the market maker opened the market for option during not after he sets his book. So during the first 15 minutes, the stock may be trading at your red target major, but the option market is not open, or some options are crazy. Have you seen like in the morning? I see all day. I see some stock which is very looking good. I said, okay, I can't wait to get into this trade. And then when I'm looking at the option, they are all crazy. Spread is this, that, and I wonder. Then I go to another month, and I say, okay, is this happening in another month? I have to sacrifice and buy some shorter term option because the month I want to buy, they have some crazy spread. So if you keep watching, maybe the spread is start to normalize. So in the beginning, the market maker doesn't even know. He's just protecting himself. So he just goes and puts some crazy ask. The bid is there and ask is there because that's the way he is protecting, because he has to make some money at the end of the day. So maybe if you keep watching, then it stabilizes. And when it is stabilizing, you can see which strike is stabilizing before. When the spread is getting narrower, there's a volume activity. So the market maker says, okay, now I have got this under control. So he comes to senses and the spread is narrow. That's when you have to wait to sell or to buy. So very important to know your position in the pre-market. Red target hitting in non-regular session, so important. Option occurred. Chances are stock will pull back during regular session. So if you're not aware of it pulling back in regular session, especially if you have option, you don't have a chance to sell. By the time the market opens, the option market, the position is already down. You were supposed to you were supposed to make money. Now you're losing money. The stock must gap above red target. So when the market open, it must gap up above the red target. The high made in the pre-market session, it needs to open above that and keeps going. Or if it didn't open above that, at least open somewhere below and then just keep going and keep going. Must continue upward. Pre-market alert and strategy send. So we do send out pre-market alert, revised target, etc. That this position is in gapping up or gapping down. This target is hitting, and we will be sending you the alert. So we do that. Uh, you know, that's the way we do. So we do that. What to do to maximize gain? Now you need to learn, always be looking to maximize gains. So always be looking, adding to the existing position. So we send out the alert if we see the opportunity. Rolling up, you can roll up. If you're losing in one strike, you don't have to buy, if the position is looking good, you don't have to buy the same strike, same month. You can buy something else in the next month. The original position you're looking for a break-even exit or even loss, but you'll make money in the new strike, new month. So buy a new strike, new one. Maybe you create a vertical spread, do something to maximize. So sometimes we do send out the buy more of the same. So Meta, let's say Meta we bought at 10, now it's trading at 6. So we send out the alert to average down, buy more. So when you bought one contract at 10, then you're supposed to, and it's trading at 6, and you're supposed to buy two contracts at 6. So very close dollar wise. So one is 10, which means $1,000. Two is at 6, so which means $1,200. So 1,200 plus 1,000 is 2,200. Divide by 3, so that is your average price. So we do that too. So this is the way we whole day we are operating. And then on Friday and on Sunday I will hold another webinar if I can on another topic. So please uh, do attend. And it's almost 1 hour. All right. We regarding the stop in option is very hard. So 65%, if you see 65% loss in the option, you exit. What we are doing, and soon you will see, is a time-based stop also. So if the certain position is open for a certain number of days, then exit combined with the loss in it. So if the position is open for 10 days and the loss is, let's say, 50%, then we exit. Or if the position is open for 14 days and the loss is 65, so exit. So we are working on giving you this kind of stop, all right? So we are working on the stop side too. The option, the stock moves quickly in other direction, and it is technically it is still sound, but the option is losing value. So that's option is designed. The option game is not the way is the option is not designed to put the stop. So that's where the that's my belief. So I'm giving you my belief that the option, unless you buy deep in the money, and so you can put 40% stop. If you buy deep in the money, the stock is trading at 200 and you're buying calls at 180, 175. So deep in the money, and then you say, okay, I'll put the stock. So options are for the short-term gain, is for hedging and speculation. So options uh, are not supposed to have a stop. So if you don't have a stop, then what you do, you put the dollar which you're willing to lose. Maybe you're willing to lose 100%, or you're willing to lose 60 to 70%. So if you put 30% stop on option, you'll be stopping out all day long. The slide move, the slippage, the spread, you bought it when the implied volatility was high, you bought into volatility, the stock pulled back for 3 4 days, your option went down, and suddenly the stock gaps up and just keep going up and up and up. So, and then you say, oh, I got stopped out at 30%. Now I am, if I had held on, it would be 80%. So just keep that in mind. The stop in option is not a good idea. So think about that. All right. So I'll stop here and I will see you on Sunday evening, most likely.